morning. Hello and welcome. My name is Jason Jedlinski. I am the Hill's General Manager, and I'm delighted to welcome you all here today to our discussion on securing America's retirement. I'd like to thank the American Investment Council for their support of today's conversation. A recent Gallup poll shows that 63% of Americans are worried about having enough for retirement. According to Gallup, it's the first time since 2016 that 6 in 10 Americans have been this concerned about their retirement. In this moment of anxiety, officials are increasingly turning to investment in private equity in an effort to bolster funds. Millions of public sector workers currently have private equity as part of their investment portfolio, and today we're going to talk about how diversifying portfolios to include private equity might affect retirement security and the kinds of returns that Americans might expect. What policies might ensure a secure retirement for more Americans? We're pleased to be joined this morning by members of Congress, economists, and investment officers who will help shed light on this important issue. But first, a few housekeeping notes. In addition to our audience here in the room, we're also live streaming this event on thehill.com and social media. Please keep your phones on silent for the duration of the program, but do join the conversation on social media. You can follow us at The Hill Events on Facebook, Twitter, and Instagram. We'll be using the hashtag #TheHillRetirement. And finally, for those here in the room, we will be sending out an electronic survey after the event, and we'd love your feedback. With that brief introduction, it is now my pleasure to welcome our first guest this morning, Senator Pat Toomey, the Republican senator from Pennsylvania, the ranking member of the Senate's Banking Committee, who serves on the Senate's Finance Committee. In addition to his public service, the senator has also worked in the financial services industry. He'll be joined in conversation this morning with our moderator for today's discussion, the Hill's contributing editor, the one and only Steve Clemens. Thank you.
Thank you, Jason. Hey, good morning, everybody. It's sort of weird to have all of you back in real life, so thank you. And I know there are many people online watching us. We all love you, too. And I think you can tweet, you can send questions. But thank you very much for joining us all. Senator Toomey, it's great to see you again. You're a guy who's sort of obsessed with the retirement picture. You've been at this for a while. You're not returning to Congress after your term.
Correct.
And you've made this one of the pillars of what you want to make sure you put, a stake in the ground before you take off out of that wonderful body you work with. So What's going on there? Why has this become such an obsession for you? And I say obsession in a good way.
Yeah. Well, thanks very much, first of all, and thanks for having me. But the way I think about it is we have been part of this fantastic, wonderful democratization of our capital markets. We have seen ordinary Americans, working class folks, who, when I was a young child, had absolutely no investments. They lived paycheck to paycheck, and if they had savings, it was in a statement savings account at the bank. And you earned as much as you did. And that was it. You had no other alternatives. If you did accumulate enough savings that you thought you'd buy some stocks, transaction costs were enormous. Fees and commissions were huge. Bid-offered spreads were wide. So, the domain of investing in this enormous growth machine of the American economy was left to people who were very wealthy or institutions. And what we've seen over the last decades.
And then we got Robinhood.
And now we've got Robinhood. No, it's great.
Is that a good
perfect
thing?
Absolutely. It's a great thing. It's a great thing. It is a continuation of this process that makes it easy and affordable for people to participate in the accumulation of wealth. And that's a great thing. A big part of that, let's be honest, for most Americans, their wealth is tied up in their home, which that's not something you trade. But the other big category is retirement savings. And so for me, this is just a really, really important part of allowing ordinary Americans to have a better life and a comfortable retirement.
Well, one of the things we're kicking around today is the American Investment Council. They're underwriting today's forum, and they have released a report which we're going to, I think, kick around a little bit today. But they've looked at the role that private equity has played in the way at least some Americans' retirement is being handled, and and honestly, they're very proud of it because the robust returns are there. As you look at that part of the picture, of the retirement picture, how significant is that asset class to you? How important is what we're seeing in the equation of retirement success being linked to some of what's happening in the private equity
I see
world?
the way you're leading up to my legislation. I appreciate that. But so it's so important, right? For a few reasons. One point that I think you alluded to is really excellent returns, right? The numbers for private equity have been very, very good. And it's not just because the best stock pickers in America happen to have decided to be in private equity. It's the fact that most of the most successful private equity firms add value to their portfolio companies. That's their real reason for being successful. They have developed an expertise, very often it's industry specific, where they make an investment and then they immediately begin to add value in the management and the operations of that company, and through the networks that they have, they bring an awful lot to the table. So there is a good reason why they have been able to have very high rates of return and performance numbers. And one of the things that I have wanted to do is to expand the categories of asset classes that ordinary people can invest in, very much including private equity for these reasons, but also including other categories as well that are still mostly off limits.
And lo and behold, you have written the Retirement Savings Modernization Act.
Imagine that.
And so tell us about the Retirement Savings Modernization Act, because my understanding is not a lot of folks have actually read it yet. So can you reveal some of the key pillars of it?
I can. So they haven't read it yet, in part because we have not formally introduced the bill, only because we have not yet nailed down a Democratic co-sponsor. I think we'll get there. Any help will be welcome, but we're talking to a few folks who are interested. But here's the idea, right? We all acknowledge that high net worth individuals, big financial institutions, family offices, you name it, every category of investor with a lot of money invest in a wide range of asset classes. They're investing in real estate, they're investing in private equity, they're investing with hedge funds, they invest in commodities. It's part of a well-diversified portfolio. Everybody does it. The one big quasi-institutional category that can't do it, as a practical matter, it's not necessarily technically that they can't, but as a practical matter, are defined contribution retirement plans.
Right.
And there are 8 times as many defined contribution retirement participants as defined benefit plans. It's a huge category. It's more money. It's more people.
Why is that?
So why is that? Great question. So the reason is these plans are regulated by the federal government under the statute called ERISA. That's the acronym for the retirement legislation that governs this. And in ERISA, the language is ambiguous as to whether or not it is fully permissible for the asset manager to invest in these asset classes. And the fair is, if an investment manager, if the asset manager for defined contribution plans did invest in alternative assets and something went badly, they could be sued merely for the fact that they invested in these other categories. If you're in a defined contribution plan, a defined benefit plan, as long as the manager makes the payments obligated, nobody's harmed. And so the risk of litigation is much, much lower. The risk is considered to be unacceptably high. So all our legislation does is it makes it clear. By the way, with respect to both.
I don't mean to interrupt you, but I really don't know the answer to this question. We've got experts here in the audience and online that do with Will. But how solvent are our DB plans now? How defined plan? I mean, one of the big issues is obligations, resources, retirees, and defined benefit. And one of the big moves from defined benefit to defined contribution is the fact that we were that people were living longer, that it was a problem of solvents. How solvent are those?
Well, as you know, it varies. On the private side, the strategy, if you've underinvested for too long, is to come to the government and get a federal bailout.
Right.
We have state and municipal plans that are wildly underwater. Now, we had a massive rally up until the beginning of this year, which helped a lot. But my understanding, and I've not studied this closely recently, Steve, but my understanding is even with that rally, many of the biggest plans are still significantly underwater. And with the sell-off that we've had in virtually all asset classes this year, I got to believe that they're underwater. So that's a problem. But anyway, back to the legislation. The idea is very simple. You make it clear that an asset manager would not be violating their fiduciary obligations solely by virtue of investing in an alternative asset class. All the other obligations of all the other fiduciary obligations still apply. So the diversity requirements, you still have all the prudential requirements there, but you don't systematically exclude this enormous category. And by the way, it's commodities, it's precious metals, it's hedge funds, it's private equity, it's all of those categories that are
And
completely
dare I
unavailable right
ask
now.
crypto?
Sure, yeah, crypto too.
And so in the crypto front, I was with the guy who's the head of the Crypto Association in Washington yesterday. I said, "How you doing?" He says, "I'm a little wobbly." And I had just had 3 companies go under.
Yeah.
And so when you kind of look at that and kind of look broadly at the question of retirement, is there not, it's one of the things, to come into the private equity and performance of looking at performance over time. And it's like, we all know in investment there are no guarantees in life, right? So, but part of it is how to look at constructive long-term investment and gains in performance.
Absolutely.
And do these other asset classes have the performance criteria that you think deserve for inclusion?
Yeah, so first of all, the only one that I can think of that is truly new is crypto, right? Commodities,
Right, real estate,
thousands of years, real estate, thousands of years, right? So there's very, very long track records for all of these other categories. That's not an issue there at all. With crypto, I think you do have to divide the crypto world also into there are different categories of crypto, and you have to acknowledge that much of it is very speculative. And so, okay, it should be treated accordingly. Your fiduciary obligation as the asset manager would be to be very careful and to make sure that the overall portfolio is very diversified. This presumably should be a small slice of a retirement portfolio, but I think it'd be a big mistake to exclude it. We just don't know where this is going, and I actually think the underlying technology is very, very powerful. So yes, I think crypto is on the list and should be on the list.
Who are you, well, I know it would compromise you to ask who. Why not Joe Manchin?
I don't want to suggest I have no objection to Joe Manchin. Joe and I are good friends. We do a lot of work together, and he might very well. I don't think I've had a chance to actually speak directly with him about it.
When you're back in the Trump White House or the Biden White House, who would be the opponents to what you're trying to do? Who's unnerved by what Pat Toomey's trying to do with retirement modernization?
Well, to be very candid, I have some colleagues who've been extremely vocal about a hostility to the entire private equity activity. I think.
Why? Where does that come from?
Look, they mischaracterize it grossly. And look, has there ever been a case where a private equity firm has bought a company, leveraged it up, slashed and burned, and then flipped it for a small gain? I'm sure that has happened. They characterize that as the fundamental business activity of private equity. That's wildly wrong. And they have this ingrained hostility. And it's totally misplaced, but that I think, is the likely source of pushback.
When you look at...
Which, by the way, is completely inconsistent on their part because they have not attempted to preclude private equity investment on the part of defined benefit plans.
Right. So it's an inconsistency on that front. And it just raises an interesting thing. I was talking to some of our friends in the American Investment Council, they say, where does this come from? And I do know, some of those cases in the past, but when you kind of look at data, you look at, today we're going to have, I think, some folks on stage that are responsible for some of these major pension funds and their performance.
Yeah.
And it's very impressive during a time, frankly, where there's a lot of economic anxiety in America. And I think one of the questions is we're looking at with retirement, and I think even today we're looking at one portion of that picture. But if you look broadly at American economic anxiety and what kind of, I talked to Nancy Lamond at AARP, and Nancy says the future of retirement is work. And so, but I kind of think in this realm, I know you're doing this piece to broaden the opportunity, but what would you say when it comes by way of private equity and kind of looking at the performance which they're publicizing and putting out there? What's the, from your perspective with presidential administrations, is the story that might turn that around? Might turn their impressions around of the contributions of private equity?
There's a handful of folks that don't want to turn around, right? They're not interested in looking at the facts and coming to a different conclusion. So we've got to just accept that we're going to do this without them. Right? I've never expected that this was going to be 100 votes in the Senate. But I'd be quite happy if we're over 60 and we're able to pass this, which, by the way, I think we will do.
Oh, that's interesting. So, and you're also part of the Secure 2.0 Act? Mm-hmm. Tell me about that.
That's the House bill, I think.
Okay.
Right? The Secure Act, I think, is the House bill. There is a Senate version, so to speak.
Okay.
And it's a wide, long list, and I don't have it all committed to memory, Steve.
Neither did
But-
my notes here
yeah,
with my
yeah.
team.
But it's a long list of modest, but I think all constructive reforms in the rules regarding retirement accounts. When you have to withdraw, how much money you have to withdraw, under what circumstances. I have several pieces of legislation that are part of it that are designed to provide fairness, for instance, for state and local law enforcement officers who, after 20 years of service, federal employees have been able to do things that state and local have not. So it's this wide range of measures that makes it more attractive to save more for retirement.
Let me ask you finally, and I think we will take a question from the audience. I know you've got a hard out at 8:50, but I used to work for Jeff Bingaman in the 1990s, and I can't remember the savings plan we had. I'm sure we had moved from a defined benefit to and I definitely wasn't going to work for the government for 20 years, so I didn't worry about all that. Right. But by way of whether it's thrift savings or whatever plan is up there covering you and other Senate employees, are those plans experimenting at all with some of the suggestions you have made about modernization? Are they looking at other asset classes like private equity with regard to, so I'm always interested in the gap, if it exists, between what the government is doing to secure its own retirement benefits for its employees versus what's happening out there in the private industry.
It's a great point, and I have not focused on that very closely. My experience from my own personal involvement in the Thrift Savings Plan, which is what's available to all federal employees, and Congress has the same access to it, no different than any other employee. They're it's quite a narrow list of choices. Like you've got a traditional government bond fund, you've got some other quasi-fixed income fund, you've got emerging markets, you've got domestic equities. But it's pretty limited, as I recall. Now, maybe I'm missing something, but I think it's a pretty limited list. And you raise a good point.
So that might be an interesting
It'd be a great place
Yeah.
to allow for another whole range of investment options.
Well, Senator Toomey, thank you for sharing this. Let me ask if we've got a question or two in the audience real quick. Questions, comments? I'll pick on someone. Yes, right here. He's with Tax Notes.
Okay.
Go ahead.
Hi, Ben Guggenheim for Tax Notes. So there have been 3 iterations of this, of the EARN Act and the Passport-Min-Cardin legislation, one in 1996, one in 2001, and one in 2006, all kind of based on the same premise that if you raise required minimum distribution ages, catch-up contributions, you're going to incentivize people to save more for retirement. But back in 1996, half of Americans didn't have retirement, and a 2022 survey by the Employment Research Benefit Institute shows that today half of Americans don't have retirement. So wouldn't that indicate that the whole approach to incentivizing retirement savings by loosening up investment decisions isn't working if over the span of more than 2 decades, half of Americans still don't have any retirement savings?
Thank you.
Yeah, so I'd welcome the actual data you're referring to. I'm surprised to hear a characterization that the percentage of Americans with retirement savings has been flat for multiple decades. That does not sound intuitively consistent with bits of data that I've seen, but if you've got data to the contrary, I'd be happy to look at it. The other point, of course, is even if that's true, then that doesn't necessarily mean that these incentives are not constructive and that they're not helpful. There obviously are many other factors that would contribute to whether or not people have retirement savings and to what extent. But I'd welcome a look at the data that you're referring to.
Well, I think, just to wrap up point, it does raise an interesting point that if you have, it's one thing I think the conversation today, and we talked about defined benefit plans, that if you're fortunate enough out there as a worker to have the social contract in your employment history, that you have this savings, there are options that are becoming much more interesting out there and diverse and high performance like we're discussing today. But if you're not in those systems, you can, then you're back in the Nancy Lamont box that you're just going to work, until the end, and the retirement dimensions of that are much more bleak. And do you see anything on the horizon that's that's hopeful, that deals with the bleak side, to get to your point, of Americans who are not covered by retirement?
I just think we've got to continue to increase the education for Americans. I think it's apocryphal, but the line attributed to Albert Einstein that the most powerful force in the world is the force of compound interest. It's really true. I mean, if you start saving modest amounts of money as a young adult, even if it's painful and clearly you don't have a tremendous amount of excess money, boy, you're going to be really glad you did when you reach retirement age. And we've got to continue to proselytize that.
You have about a year and a half left of events with the Hill.
I'm not sure what you're. I
Oh
leave
no!
office
I guess
in
you got
year.
half a year.
Yeah.
Half a year left.
Don't try to keep me here longer
okay.
than I.
Half a year. What are you going to do next?
Oh, I have no idea. I've got nothing lined up. I'm not a doctor or a lawyer or somebody who's got a shingle he can hang and go back to the old profession. But I'll find something. The important thing for me is to run through the tape here. I've got this extraordinary opportunity. I'm the ranking Republican on the banking committee. That's a new responsibility for me, and I want to accomplish everything I possibly can in this last sprint, cross the line, and then I'll find something to do.
Final question as you leave this institution. I'm interested in your sense of the temperature on whether we will get back to a point where bipartisan efforts are the norm and not the boutique exception.
Yeah, I've wrestled with this question for a long time, and I do think the Senate needs some tweaking of some of the rules. Certainly not elimination of the filibuster, but there's some things we could do that would acknowledge that we're in a different political culture now, and a different political culture requires different rules to allow the Senate to function well. But look, we're polarized as a nation. We're polarized here in Washington. My theory has always been to find common ground where you can, take small victories, and hope that it builds and creates some momentum. I will say for all of the polarization that's very real, when the chips were really down during the pandemic crisis, Congress came together and we passed a series of bills that were massive. They were unprecedented. They were huge. They caused a lot of heartburn for a guy like me in a variety of cases. But we felt that since the governments across the country were shutting down the economy, we had to step in and really replace lost income on a scale that none of us had ever imagined. And those bills passed almost unanimously. So in the end, we did too much of that. But the point is, Congress was able to come together and do some very big things at a moment when the country needed it.
Well, ladies and gentlemen, Senator Pat Toomey, thank you so much for joining us today. Terrific, and good luck on this legislation.
Thank you very much.
Thank you.
Yeah.
Thank you again to Steve and Senator Toomey. I am pleased to welcome to the stage now Pam Hendrickson, Vice Chair of global investment firm The Riverside Company and Board Chair of the American Investment Council. For our sponsor perspective this morning, Pam will be in conversation with Drew Maloney, President and CEO of the American Investment Council. And now we will welcome to the stage Pam and Drew.
Well, Pam, thanks for joining us today.
Happy to be here. Thank you very much.
One of the reasons that we like to host events like this is to really highlight private equity's role in supporting pensions and pensioners around the country. There are approximately 5,000 private equity firms that are all competing to invest and partner with pension funds. And Riverside, where Pam is the vice chair, is really focused on small businesses and dealing and does a lot of work with pensions. So Pam, maybe you could explain a little bit what the relationship is between Riverside and the pension funds you work with.
Sure. Today we manage over $14 billion, and about a third of that money comes from pension funds. And those pension funds are everywhere from Maine to California. And we partner very closely with all of our investors. In fact, one of the core values at Riverside is investors first, because we're in a very competitive environment, And we often say that raising capital is like survival of the fittest, because if you don't do what you say you're going to do and you don't deliver something that is asked of you, you don't raise your next fund. Also, some of our state pension funds in particular really like to co-invest alongside us. So when there's an in-state deal, we will show that to them. And we've had states from Oregon, states like Texas, where there have been in-state companies, and we have shown them those deals, and occasionally they co-invest with us.
Well, I think that brings us to the point of our, you might need your, of our
Apparently my mic is not working.
of our report. I mean, and one of the things that we were here to highlight today is the fact that the pension returns, we do this annual study, and this past year, we had a 15% average return over 10 years for the private equity investment in pension funds across America. And if you think about how important this is, we all know that pension funds are struggling to meet their obligations around the country. And we have 30 million Americans that are dependent on these retirement benefits. You've got firefighters, you have policemen, you have teachers. We're going to have Faruqi from Ohio coming up, and he's got his fund covers janitors, cafeteria workers, bus drivers. All these people are dependent on these returns in order to have a comfortable retirement. And for us being able to deliver year after year one of the best investment performances for private equity inside of a pension fund is really an amazing achievement. And I think we have to continue to do a really good job of explaining that. And I think one of the things that we always talk about is, like, how does that happen? And that happens because you have active managers like Pam and Riverside and other companies really working with these small businesses. And if Pam and Riverside, they only invest in small businesses. 74% of our dollars go to small businesses. So Pam, explain a little bit about how this works with the companies you interact with.
Absolutely. I think it's interesting because, Senator Toomey made the comment that the active management, the intellectual provision that private equity provides to the 74% of, I only can talk about small businesses because it's all we do. But just to give you a couple of examples, because I always think stories are better than anything, than statistics. We invested in an Ohio-based company called N2Y. It was it was created by a teacher who noticed that in the public schools there was no curricula for children who are on the learning disabled spectrum, particularly those on the autism spectrum. And so she created a company that did that. And when she wanted to retire, she really wanted to pass the company to her daughter. But the daughter had never been the CEO of a company. So we were able to help coach that daughter through how do you be the CEO of what's now a pretty big company. In a similar example, we made an investment in a company called Onsen, and it's a manufacturer of fragrances for the cosmetic industry largely. And it has struggled mightily with supply chain and cost issues. In fact, the CPI numbers just came out, and it's a 9.1% number, so that is really high. And we helped that company to both segment its client base and figure out, like, what is the right pricing strategy according to what fragrance you're buying. This is the type of thing that we do. And that company's results are a 3.5% increase in sales through June. And that's what the bus drivers and janitors and teachers need to see, because that's the thing that growth is what is gonna drive returns for them.
I mean, you highlight the challenges that we have with 9.1% inflation, supply chain challenges. All while this is going on right now, you have regulators in Washington, the SEC, the FTC, and others that are issuing thousands of pages of new regulations that will impact how investment dollars flow, how funds operate. You're a small fund. You invest in small businesses. Tell me, how does these new proposed regulations, how are they going to impact how you all operate?
Well, what worries me is a small company like the one I just described, Onset, they're really struggling with their supply chain and their cost issues. So how is a company like that then also going to add another layer of reporting so that somebody can read it or put it in a room somewhere and never look at it again? I don't know that that's going to help all of the teachers and policemen who are relying on us for returns. I mean, because what we're trying to do is to grow our companies. And, perhaps we're not reporting the way people would like us to, but I think we are. We've never had a situation where any of our partner investors are unhappy with the reports they get. Anybody wants anything, they can get it from us. And in fact, I think you actually, or I think there was a study recently, a poll recently of a bunch of CIOs.
Yeah, I think that's right, that most of the pension funds believe that the existing relationship works, and I think only 6% said that there needs to be more regulation in the industry. And I think, this report sort of is proof positive that, a 15% average return over 10 years means it's working. So let's not disrupt what's already working. I think it's important that, and from what I think you're saying, Pam, is I think it's important that the resources that these funds use or should be dedicated to the companies that they're investing in and they're working with, and not investing in hiring more lawyers to send more paperwork to Washington.
100%. It's both the resource cost and the opportunity cost. Do I want my people spending time, segmenting the client base so we can figure out the right pricing strategy, or reporting?
Right. No, that's right. Pam, thank you for being here today. Here's to big returns for next year.
Here's to big returns.
All right.
Thank you.
Thank you, Pam and Drew, and thank you again to the American Investment Council for their support of today's conversation about this important topic. As we briefly reset the stage, please welcome next up our panel discussion with Jason Fichtner, Vice President and Chief Economist at the Bipartisan Policy Center. He'll be joined by Faruqi Majed, the Chief Investment Officer of the School Employees Retirement System of Ohio, and they will once again be joined in discussion by the Hill's contributing editor, Steve Clemens. Jason, Faruqi, Steve, thank you.
Great, thank you very much, Jason. Okay, folks, if you weren't looking, it's 9.1% is the number, and this is not our conversation, but I just have to say it because we're in the news business. But I was on a call yesterday with Brian Deese, who's the President's National Economic Advisor, and he did not know the number, clearly, because he was saying why it was likely to come down. Gas prices were coming down, price of oil, a lot of the structural core components that were going into the index that they watch were coming down, and they thought of it. So it's 9.1%. So I just need to sort of start with the news, to both of you. Are you surprised, and is this a red alert? Jason?
I mean, I'm always surprised because I always thought it was going to go down, but realize we are still.
They did too.
Well, realize we're in a COVID
That's why they did a
environment,
call with us.
and we still have a lot of supply chain issues that we still have to come out of. But the one thing you didn't realize or get to when you're thinking about inflation is what that means for the Social Security cost of living increase.
Right.
That'll happen, which will most likely be the largest increase in 40 years when they announce it
Right.
in the fall.
Faruqi, as you look at your investment horizon, does this frighten you at all?
It doesn't frighten me. It sort of challenges me in different ways. I've said for quite some time that we are in very unfamiliar territory as far as investors go, right? We've had 3-4 decades of an economic regime where we had inflation trending down. So that was a secular trend. Interest rates trended down. And macroeconomic volatility was way down. So that regime is now changed. So we have passed, I think, the inflection point. We will see higher interest rates, higher inflation than the 2% that the Fed would like to see. And so that creates a different kind of investment environment. And the conventional portfolio would have some challenges dealing with this new kind of environment. Thinking of rather the 60-40 equity fixed income portfolio.
Right. So Faruqi, let me ask you, because today we are talking a little bit about retirement broadly, and we're going to get to the broad picture. We're also looking at the variety of investment tracks that someone like you have a huge fund in the School Employees Retirement System of Ohio, and apparently you had a really good year last year, you know, and people kind of were celebrating. You had a 26.7%
Yes.
return. You know, we all want to know the secret to that. We have a lot of people online saying, hey, we want to sign up for your, you know, Twitter feed. But as you kind of look out there and you look at how do you distinguish long-term returns, you know, and I've been sort of this, I've been kicking the tires of, you know, the private equity issues and, you know, how it builds, so how do you see that dimension of class of investment with regards to what you're doing as you steward the retirement savings of teachers in Ohio?
Yeah, so our expectation or the actuarial interest rate assumption is now 7%.
7?
Yeah.
Okay.
So that's over the years, that's come down from 8 to 7.5 to 7 in different kind of steps. So that is, there is an expectation that the going forward returns would be lower than what we've been able to generate in the past. As you reduce your expected rate of return, the actuarial interest rate assumption, your liabilities go up in the computation, and therefore the challenge of meeting your long-term funding goals become more of a challenge. But our fund, the funded ratio currently is 74%. It was as low as 62, 64, something like that at the end of the financial crisis. So we've made some, you know, very steady progress here over the last 12, 14 years. So over the next 10 years, I don't think we will have, you know, we can gain the same sort of increase in our funded situation, because I think our expected returns are going to be much lower than what we've been able to generate in the past 10 years, which is about 10.5%. The other issue that many mature pension funds have is the cash flow situation, which is that they pay out more in benefits than they get in contributions, because the retiree role keeps growing. The active employee role is not growing that much. So the ratio of retirees to actives keeps increasing.
Right.
So that's another challenge that mature pension plans have. So we're dealing with those types of multiple issues. But one of the things we've done is try to be as nimble and tactical as possible within the limits that our board has given us in order to try to steer the fund through these rather choppy periods. So for the year ending June 30, 2022, our preliminary returns are just a tad below zero. But our policy return is something like -5% odd. And I know some of my peers are reporting returns as bad as -7, 8 sort of percent. So we've been able to be somewhat nimble there, to have very low exposure to fixed income. Last year we were
So
at the bottom.
you're basically telling us something very important, that we can't get addicted to these giant returns you got in the last fiscal, that there are real challenges out there
Yes.
in the economy. And I would just jump to you, Jason, and ask, you know, I always find economics, you know, slightly close to alchemy, right? So trying to understand, you know, what are the dependable parts of it? And in my book, the dependable parts are tracking over time, looking at performance. And I'd just love to know in your map, what's the scaffolding we should care about? When you look at the private equity world, they're investing nearly $1 trillion last year. You know, Drew was up here, did this kind of cute thing the other day in Union Station, walking through, you know, kind of identifying all the companies that had private equity behind them. We heard Pam talking about private equity and a lot of small business. So there are a lot of dimensions there. What would you say are the blind spots in that discussion? What do we need to understand about capital and equity and investment in this economy that we're not getting right?
I think one of the things, this is where Faruqi brought it up as well, and you mentioned it, we need to start thinking about cash flow. So when do you need to have cash coming in? And this goes back to Senator Toomey also with the defined contribution plan.
Right.
This is not just about DB world, it's a DC world too. We are shifting from a DB economy, a DB retirement system, to one that is primarily DC. But
that's been a many decade
but
process.
But it's still ongoing. And the
Right.
thing is that what the DB world was so good for was giving people a paycheck for life, right? That's
Right.
what you're trying to give them. You're
Yeah.
promising a benefit.
Right.
But they were underfunded. You had some plans that failed. Private DB plans were going the wayside. You still have some state, local, and teacher left. But now we're going to a DC world because there's access to the market. But people are losing now this paycheck for life they like. So now we got to think about how do you have your DC plan have asset allocation
Like
that
what
includes
they have,
private
yeah.
equity, that also includes something like maybe a partial annuity or annuity to help complement Social Security. So the blind spots go, one, education, which Senator Toomey meant. And the second, remember when we were all growing up, and one of the first lessons we learned about investing was diversification. So think about all this as asset allocation. What money do you need to have in fixed income? What do you want to have in equities? What do you want to have international? What do you want to have in private equity or hedge funds? But you think about this as a long-term allocation. Some things you're going to want to have, like dividend-paying stocks, are doing very well right now. They're paying out record amount of dividends. How do you allocate those and start thinking about this from a cash flow perspective? And this changes over time. So history is not necessarily the best indicator of the future, but we look at it. But the question now is, how do you figure out your portfolio mix, your allocation mix? And we start thinking about, I've been looking at this more in the target date fund world. We've made it really easy for people to default into a target date fund.
Mm-hmm.
Now, not all target date funds are the same, but we're allowed to have that.
Just for our
But
viewers'
now
sake,
imagine
can
this
you
one.
explain what that
So
means?
a target date fund is basically, imagine you have a defined contribution plan, you go through Vanguard or Fidelity, they all
Right.
have these funds, and they say, what year do you think you're going to retire? 2050, 2055, 2060. They then have a mutual fund that is an investment portfolio of a variety of different equities, internationals,
Designed to
bonds.
get to that date.
It's designed, but it reallocates every year. So
I
this
see.
goes into the allocation. If you're young, you're 25, you're not retiring for another 40 years, you have time to invest in assets that are less liquid, for example, say private equity or
Right.
stocks, that over the long run perform better on average. So you have a chance to grow those up. But as you get closer to retirement, need more fixed income or dividend-paying stocks, the allocation will change automatically towards those. Now thinking about someone who needs some sort of fixed income protection or annuity, you could have some contracts in a target date fund that buy annuity contracts to give some of that paycheck for life, that DB type component.
Right.
But to get that allocation, to get that high asset amount for retirement, you've got to have a great allocation going up that has good returns, which means you've got to have some private equity, some equity as well. And this is where I think that the education is missing, is that people want to say, you can't invest in this, you can't invest in this. The question is, you can, but at what percentage? What is the right allocation amount, given the risk portfolio you have,
Right.
the age, and when you start needing to have cash, whether you're a DB plan or a defined contribution plan investor? That's what we're missing, is this conversation about how do you grow assets over the long term, what's the proper allocation you need, and then when you get to the point where you need cash flow, how do you make sure you have that cash flow coming in?
Faruqi, let me ask you another dimension about your investment decisions, and you do it. I have spent a lot of time looking at the private equity world and things like renewable energy or other kind of ESG-like activities that are out there. How much does that come? I mean, how much do those factors come into your calculations in a real way? And I'm just asking, bottom line, does ESG stuff matter to you or not? Is it just simply raw financial performance that matters? As you look at the performance of, we know from the report that's just come out from the American Investment Council that those pension funds that have brought in private equity have done remarkably well. Growth rates 15. The performance has been 15% or higher in many, many cases that I was looking at. But that side of it, what are you looking at? Because a lot of us in Washington, I think, are easily distracted by the shiny penny of whatever newfangled thing is out there. But what's on your radar screen? Just
Yeah.
give it to us as it is as
Yeah.
real.
So we are very much focused on the returns. So that's how we look at opportunities, right? So as you mentioned, our private equity return as of the end of June 2021 was 17.6% over 10 years. As of December, it's 19% 9.2 over 10 years.
Right.
And the 10-year total fund return is 10.5. So we were able to get to 10.5 primarily due to very solid private equity returns of 19.2% over that
So
period
wait
of
a minute.
time.
So what was the worst performing part of the portfolio?
Yeah, over the 10-year period, the lowest returning asset class obviously was fixed income.
Which may not be the case going forward. So but I think
Yeah,
what he's also
we
getting
focus
into, and
on-
this is
yeah.
the idea, is the private equity return was fantastic, but you don't have 100% of your assets
In private equity, no,
Right.
you don't.
You're
So
trying to balance a
we
risk
have
portfolio.
10%. We are now increased to 12% because our board would like to see more of that kind of return to improve our return. So that is our primary focus. And fortunately for me, as the CIO, our board is very much focused on that as well in terms of their fiduciary responsibilities. They do care somewhat about things like ESG and so on. We tell them what we are doing. We are very strong on the G side of E, S, and G, which is the governance part of it, in terms of how we vote our proxies, how we get engaged with companies in terms of shareholder proxies and votes and issues like that. So on that part, we are very active. In terms of the E and S, we don't have any board-directed mandates in terms of, say, for example, divesting from fossil fuels. I know many...
You don't have that. Is that unusual you don't? Because I don't know what the standard is in the industry.
It's not unusual, but many state funds, particularly the larger state funds, like CalPERS and so on.
CalPERS
Right.
does have some of that.
Yeah, they do because, these interest groups that are interested in those kind of policy matters tend to focus on, those types of funds. So nonetheless, we do think there are opportunities, even though I don't have a mandate to put X amount of dollars into environmental or alternative energy and so on. But we are seeing opportunities, and where we see opportunities, if we can get the kind of return expectations that we have, then we are happy to invest in it. So we have invested in what are called climate mitigation type strategies.
Right.
So these are some private equity type investments that are focused on improving energy efficiency, particularly in certain types of high energy intensive industries, like steel and aluminum and so on and so forth. So those are designed to improve energy efficiency in terms of the usage.
Right.
So and then we do have some in alternatives, perhaps solar and so on and so forth. So those are the kind of opportunities that we are interested in.
I think about what Faruqi's doing, what he has to be. He has a portfolio and he has beneficiaries. He's got retirees that are current and his retirees that are coming in. He has an actuarial concept. Here's what I've got to pay out the next couple of years.
Right.
So in some ways, he has to have a portfolio that has some liquidity to pay out current benefits and benefits that might come next year. Then he's got to grow the assets also coming in to make sure he's got enough cash to pay 10, 15, 20 years out.
Right.
So when we start thinking about this portfolio allocation, when I start hearing people talk in the policy circles that, well, you shouldn't invest in private equity, or it's too risky, you don't want to do this, you need to have a risk-adjusted portfolio that includes things that have long-term average higher returns. That's the only way you're going to have the cash to pay out benefits 10, 20 years from now.
Do you dream about risk-adjusted retirement
That's all we
portfolios?
do. So the one thing that, that recently fell into I've been appointed to the Puerto Rico Pension Trust.
Let me ask you,
So I have to do this
what's
now
your
for a living,
first
too.
name, my friend at Tax Notes? Ben Guggenheim with Tax Notes. Ask a question. It's just been twirling in my head. And he really said, look, with all this stuff that we've been doing in retirement broadly, half of Americans don't have retire. Is it half of Americans don't have retire? And so, it reminds me when I worked in the 1990s in the Senate on health policy, and we were looking at, we had at that point 13 major health reforms, and you couldn't show that you had covered any more Americans with health insurance. And eventually, you know, the Affordable Care Act, it did make a dent in that. But you know, we had to kind of look at the fact that everything that we were trying to do with health insurance was failing. And I went to the retirement side because I was involved in helping to write legislation, and I think it was called the Pension Pro Save Act or something. And it was at that time a way to try to put together a system, particularly for service workers and, you know, labor workers that were that rather than having them put the first dollar, you know, in savings first to potentially be matched by the dollar, it gave employers the option of putting, you know, that first dollar first and putting dollars there. And we were looking at ways in which we could get some element of habit and of savings behind more Americans, and thought that would be there. Now, I don't know the situation today. I know what it was 20 years ago, 25 years ago. But I'm interested in his question in whether or not we're playing with the world of those that have, and they're getting more options. But what do we do with those that don't?
Well, so don't forget,
Jason.
when we talk about retirement, we think holistically, right?
Right.
And so that includes your own personal
Right,
savings.
yeah.
That includes either a DB plan or an employer-sponsored defined contribution plan.
Right.
And there's that third pillar, right? We always talk about the three-legged stool. What's the third leg? Social Security. So we need to make sure we have good Social Security policies, so Social Security is solvent. We don't want to get to a point, we're looking at trust funds being depleted around 2034, 2035 right now, where if Congress does nothing, and so far they don't seem to be on track for doing Social Security reform anytime soon, we could see a reduction in benefits of 20, 25%, which hurts those who rely on Social Security,
Right.
or a tax increase that could be 33% increase in your payroll taxes, or some sort of allocation of government revenues that go to the fund. Maybe we do some sort of private equity, try to make up revenues and for future gains. But Social Security has to remain solvent because a lot of people still rely on Social Security. But we now need to think about this as a economic system, a holistic retirement system. Because for some people, they're going to get Social Security and have a
Right.
small defined contribution.
Well, you're at the Bipartisan Policy Center. Can't you just fix this? Talk
We're,
to
hey,
both sides.
we're trying, we've been doing good, and give
Yeah.
Congress credit. Secure Act was very good. Secure Act
Yeah.
2.0 will now allow it that goes through for some automatic enrollment for people, so employer plans. The states have stepped up,
Right.
where there now have state plans to let people who don't have access to an employer plan do it through the state. So we're starting to actually move the needle, and a lot of this has been done in the last several years. So, but for those people who are starting small, they might get to retirement with a small DC plan and Social Security. So then you think about how can you leverage Social Security? Social Security is the greatest, best inflation-protected annuity you can buy. For every year you delay claiming, it's an 8% return you get on your monthly payments. Maybe we can use that small DC wealth they have to allow them to delay claiming Social Security. 1 year, 2 years, 3 years, up to 7 to 70. Now we need to talk holistically. How do you how do you grow that
Right,
defined contribution assets to something that gives them a stream of income
Right.
to allow them to have something?
We're right near the end, and I do want to take a question maybe from Mark Bloomfield, that my friend out here in a second. You know, just picking on you, Mark. But you know, one last question is: we think about the private equity side of what we've seen as the performance of the release of the American Investment Council's report. I'm just interested, if there were to be a greater diversification of investment choices made by DC plans or others out in the investment community, you know, the level of overall private equity investments, as I understand, is around $1 trillion a year and growing right now. Does that, and I hate to, I mean, I don't want to upset them in a way, but I mean, does that dilute, or, I mean, what does that do to performance? Does that
Yeah.
change the fact that, you know, they've had extraordinary performance over the last 10 years? Does opening up those options increase, decrease, or not affect at all the factor of private equity
It's
in American investment?
hard to tell right now, but you would think that it could possibly lead to some dilution of returns.
And why would that be?
In the sense that you know, when you have more and more dollars pouring into this, and then the investment opportunities, right? So you're going to have to go look for investment opportunities. There's going to be competition amongst the various asset managers. And so what happens in cases like that is sometimes the multiples on asset purchases can go up. Means they're paying up more money to buy a company than they otherwise would have done. So when you pay up upfront more money, then
Right.
Your potential returns down the road are sort of clipped by that extent. So there could be, I don't know for certain, but our strategy in private equity We are not a very large fund, right? Like in the hundreds, several hundreds of billions of dollars that others have. And so they have to put out tens of billions of dollars in private equity. Our private equity portfolio is about $2 odd billion. So we are focused on what we call the middle market and small market buyout kind of opportunities.
Right.
We think that those will still be somewhat protected from, new inflows that might potentially come through the opening up of private equity to, individual investors and so on and so forth. So it depends on, what kind of.
Right.
I don't think every private equity asset manager is going to opt to do this. The larger ones, I think, would do, like the KKRs and the
Right.
Carlyles and Apollos and things like that,
Right.
possibly. And many of them are publicly listed companies as well. So they might.
Jason,
There's a
just
flip
quick
side to
second,
this.
yeah.
There's a flip side to this, right? The more money that comes in is chasing investment return. You get to what's called regression of the mean, right? So the way to chase dollars means you're getting more closer to the average of the market. That also means you potentially would reduce risk, so that your variance on the tail side would also narrow as well. So you might get the best of both worlds, maybe a little bit higher return, a little bit less risk for it in the long run. And I think what Faruqi's getting at, which I think is important when thinking about how we educate and talk to consumers about this and the public and beneficiaries, is it's not just how did you do last year, it's how has this performed over a 10-year basis.
Right.
Then you show the ups and downs and how it averages out and how in the long term you're better off having this diversified portfolio.
Right.
That includes private equity. Again, think about asset allocation, how you grow this for the long term so you can have the cash to pay benefits when you need it.
Fascinating. Mark, I genuinely, do you have a question? Because, Mark's president of the American Council on Capital Formation, so he's an expert in this. But do you have a quick question, Mark?
Yeah, just
Right
two
in the
things.
microphone.
Number one, you ought to be more like Steve Clements and me, which is the individual responsibility. That is to save. Unlike Steve, I drank too much and all that other stuff. The second thing, what's fascinating is,
Hold the mic
did
a little
IRAs
closer.
start in 1978?
Mark, hold the mic a little closer.
Did IRAs start in 1978? I think they did. Yeah, they did. And what I commend you all is the tremendous progress we've made since 1978. I'm here because I'm old. I want to secure my retirement. And thanks to what everybody's done, Steve, we've got 401ks, IRAs, 457Bs. So I think it's two things. It's the unfortunate human condition. We may not save enough, but what Congress and other people are doing is moving us towards a consumption tax, which is my dream. Thank you.
Well, great. Well, we will end there. I'll come back to you. Have another quick question for our gentleman up here? No. Like, bring you the mic. No, you have the answer no. Well, I will leave it there then. I want to thank Jason Fichtner, he's Vice President, Chief Economist, Chief Alchemist at the Bipartisan Policy Center. I don't mean that, I mean Chief Economist, of course. And Faruqi Majid is Chief Investment Officer for the School Employees Retirement System of Ohio. It's a pleasure for you to take us down this journey, and it's great to get a sense of the dashboard you think about when it comes to investment. What are the dependable pieces of it, and where we're going, because I think retirement anxiety is a real issue in people's lives. It's also turning into a political issue, and I think it's very important to discuss this. So thank you both very much for joining us.
Thank you.
Great.
Good catch. Good thing I had the thing on.
Thank you, Steve. That brings us to the end of our program this morning. On behalf of the Hill and our sponsors at the American Investment Council, we'd like to thank everyone who joined us here today and all of you who tuned in online. The full event video will be published shortly on thehill.com. Thank you very much and enjoy the rest of your day.